So the merge has come and gone. Ethereum's transition from proof of work to proof of stake went about as smoothly as anybody could expect. Prices, though, seem to have had a bit more of a tough time, haven't they? The native ETH token has dropped around 20% in the days since the merge happened. Anthony DeMartino, CEO of Matrixport, is going to help us understand exactly what's going on and what's behind that. Anthony, give us a sense of what you think are the key takeaways from this this huge event finally coming to fruition.
I think the key takeaways for me are the energy efficiency, especially in a time frame where electricity prices, energy prices around the world are becoming real constraints for both people and governments. I think the scalability and flexibility that we're on the path to achieving from this material upgrade is significant. I just think the achievement overall is historic for not only Ethereum, but for the crypto ecosystem as a whole. I point to the monetary policy shift now that we've moved to proof of stake, which introduces a risk-free rate for Ethereum, which will help not only institutional adoption, but also financial engineering, where we can start building more complex financial products on using ETH as a base token and earning the proof of stake risk-free rate. What I will say is, post the merge, we're kind of lacking of narratives. We've gotten to the merge at very high valuations, both on an outright and versus Bitcoin. And the macro backdrop is one of the worst I've seen in my 20-year trading career. So lots of headwinds now post-merge, and I think that's why we're seeing the market react the way it is.
You mentioned sustainability there. Let's just pick up on that. We've seen institutions specifically staying away from proof of work chains for this reason. Could we now see institutional money moving into ETH staking, and what would that potentially mean for prices?
Potentially. I think we're seeing a great amount of institutional interest, more so than adoption at this stage. Like mentioning before, the macro backdrop doesn't make high-risk assets investable at this point, and that's what crypto is. But the institutional interest is tremendous. Like you'd mentioned, moving to proof of stake, making it much more energy and efficient, takes away one of the excuses to not invest, for sure. Not necessarily it's a reason to invest. But I think as an industry, we have to move the concept of adoption away from trying to get institutional clients to buy crypto. Really, we need to get institutional clients to use crypto, right? The Ethereum blockchain, at the end of the day, sells block space. That's the revenue model. With that revenue being down over 90% since the highs of November, we're obviously failing as an industry to fill that block space with usable transactions. And I think that's where the industry should be focusing over the rest of this crypto winter, is less hype and more usage.
Yeah, let's talk more about that. Can you give us some detail about upping institutional usage? What is it that we need at this point in time in terms of tools, in terms of products? What are the gaps that the crypto ecosystem really needs to fill for institutional clients?
We had a couple of really good use cases between NFTs and DeFi. I think that looking further down the road, I think gaming is going to be a space that fulfills the blockchain use case. We've seen in real time how payments using stablecoins or CBDCs can vastly improve the settlements and movement of money around the world. We've seen examples of the usability and transportability with funding some people and governments that are currently at war. So the use cases are abound. I think we need to focus on drilling in and cleaning up those use cases from not only a technology standpoint, but also from a regulatory standpoint. It's great to build these settlement networks and payment networks, but if your local regulator is not approving it, it's going to be a challenge. But what I will say is we're seeing constant interest and investment from the traditional finance players into these types of picks and shovels infrastructure plays in the absence of just setting up custody accounts and trading crypto. So it's a good movement. This is what I believe building will look like in this winter. Maybe less so of trying to build new protocols and new technology solutions, and really working on the use case.
And before we let you go, Anthony, I just want to get a sense of how the tokenomics of Ethereum have also changed. ETH issuance expected to drop, of course, by about 90%. And that combined with the token burning mechanisms that are in place means investors are speculating it may ultimately become deflationary. Can you tell us what that would mean, what it would mean in turn as well for Bitcoin?
Yeah, so it's a great question. And I think it's probably a question where the answer is a little bit misunderstood. I think that it's misunderstood because the upgrade will allow Ethereum to become deflationary, but that is also based on activity. So if activity stays where it is now, extremely depressed, we are still somewhat inflationary, even with taking the mining supply off the market. That just points to how much activity has dropped on the Ethereum network. So as you start to see more and more activity, you start to become more deflationary, which reinforces an upward movement in price. But it also works in the other direction as well. As activity drops, you become a bit more inflationary. But as we start to scale, you can start to see where trade-offs show up in the economic model. So if you're starting to see tremendous activity in the Ethereum network, you have a choice to either continue to participate in that or use your tokens to stake and earn even higher yields in a deflationary currency. So very interesting developments to come in the future. We just need to get more and more activity on the blockchain to experience that.
All right, thanks so much for that, Anthony. That was Anthony DeMartino, CEO of Matrixport, talking to us there.